Welcome to the Asia Pacific chapter of LaSalle's 2024 ISA Outlook. My colleagues Brett Tang, Dennis Wong, and I will be sharing the key highlights of our outlook in this presentation. Asia Pacific is not immune to the changing macro environment and reduced liquidity in the global capital markets, but we see relative winners in the region. Asia Pacific, being an extremely diverse and complex region, shares some similar trends as we discussed in the global chapter, but conditions in the region also diverge from some global patterns. Our conviction strategy in Asia Pacific this year is to focus on extracting regional uniqueness beyond global similarities. Starting from the macro backdrop, we see unique monetary policies among major economies dividing the region into three groups: China, Japan, and the rest of the region. The People's Bank of China is an outlier among global central banks. As we show in this chart, interest rates in China are at historical lows. There is a high probability that the PBOC could continue to loosen monetary policies in order to restore confidence in the first half of next year. We believe the gradual improvement in business and consumer confidence should signal a bottoming out of commercial real estate demand, although the path to recovery could be bumpy at times. Despite interest rate cuts in China, by historical standards, the real estate capital market has been relatively inactive over the past year. Some cross-border investors are taking a wait-and-see view. Looking ahead, we expect a supportive monetary policy, price adjustments among sellers who need liquidity, and the opening up of the domestic REIT market could encourage domestic investors to fill some liquidity gaps left by cross-border investors. In Japan, for the first time in more than 2 decades, the economy is not threatened by deflation. But even with recent wage hikes, real wage growth remains negative in Japan. The BOJ is adopting a more flexible approach to yield curve control and wait for signals of sustainable wage growth. Most likely, even in an environment where inflation can exceed the 2% target in a sustainable manner, interest rates in Japan are likely to be substantially lower than those in the rest of the world. But we're not complacent about the impacts of increasing long-term interest rates on exit cap rates in Japan. The good news is that domestic investors play a vital role in Japan's real estate transaction market, as illustrated in this chart. The uniquely wide positive spreads between cap rates and JGBs are expected to keep income-producing properties attractive in Japan, especially for domestic investors. In the rest of the region, most central banks follow the movements of the US Federal Reserves to varying degrees, with Singapore at lower interest rates than those of Australia, Hong Kong, and South Korea. Tight financial conditions in Australia, Hong Kong, and South Korea are negatively impacting real estate capital market liquidity. The wide bid-ask spreads have translated into slow transaction activities in these markets, which is likely to continue unless buyers or sellers relent. Looking ahead, some price adjustments could filter through, especially for office in Australia and China, logistics in South Korea, and Tier 2 markets in China. So investors with assets to sell may have to be flexible on their exit timing. Overall, the capital market environment carries challenges and opportunities. Investors with longer investment horizons can be patient in seeking attractive entry points. Asia Pacific, as a region, offers market segments with the strongest performance, even in unfavored sectors such as office and retail. In the meantime, there are risks to look out for in favored sectors such as logistics and multifamily.
The dispersion among the major office occupier markets in Asia Pacific is wide. Seoul and Osaka are among the tightest office occupier market globally, while China and Australia are among the weakest in the regional context. While office availability rates are expected to increase in markets such as Tokyo and Singapore, they won't reach the levels seen during the global financial crisis. Despite this, office rental growth in the region is expected to be slow or slightly negative as landlords compete for tenants, with the exception of Seoul. Rental growth in Seoul is expected to be positive, supported by healthy demand and limited supply pipelines. In line with the global themes of bifurcation, office performance is expected to vary by tenant creditworthiness and building specification, with those offering work, live, play attributes outperforming. The wide dispersion of the region's office occupier market fundamentals is expected to provide attractive investment opportunities for investors with varying risk appetites.
Unlike office, logistics is a favorable sector in the region. However, the market fundamentals widely vary among major Asia-Pacific markets. For instance, the logistics market in Australia and Singapore remain the tightest in the region, while the markets in Greater Seoul and Greater Beijing are the weakest. The dispersion is mainly driven by increasingly diversified demand drivers and different levels of supply pipelines. Demand drivers other than e-commerce have become increasingly important for logistics demand in Asia Pacific, such as third-party logistics in Japan, new energy vehicle makers, and cross-border e-commerce players in China. On the supply side, markets with no existing stock per capita tend to have higher supply risk over the next 2 years. There are some market-unique factors affecting supply levels. For instance, in China, local governments with weak balance sheet tend to improve their finances by selling land, which could lead to unexpected new supply. With rising inflation and operating costs, logistics tenants are becoming increasingly cost-conscious. They are now less willing to pay high rents for warehouses in prime locations, but they still favor submarkets with reasonable rents, easy access to labor, and proximity to highways. Due to supply risk and cost-conscious tenants, in the near term, landlords in many markets may have to be flexible on rents in order to boost occupancy.
On the flip side of logistics is the retail sector, and unfavored sectors in the region. Retail fundamentals in Asia Pacific continue to be affected by e-commerce disruption in line with global trends. However, the uniqueness of the region's retail sectors comes from several factors, including a preference for in-store shopping and a relatively low e-commerce penetration in markets such as Japan. While rising operating costs and interest rates continue to weigh on retail space demand, limited supply provides some stability to the sectors, particularly supermarket-anchored centers in Australia and Singapore. Despite being an unfavored sector, there could be interesting investment opportunities in the Asia-Pacific retail sector.
Multifamily rental is another favorable sector due to its resilient market fundamentals and the sector's ability to hedge inflation. Tailwinds such as lower costs for renting than owning, positive net migration, and a high return-to-office ratio are expected to remain supportive of demand for multifamily rentals in major Asia-Pacific markets. Rents of the sector are expected to grow, although growth rates are likely to come off the peak levels. This is mainly because supply is projected to increase, and tenants' affordability is constrained by rising inflation and negative real wage growth in many markets, such as Japan and Australia. The expected rent growth deceleration and high entry prices, driven by strong investor appetite, may dampen returns of multifamily rental assets in the next 1 to 2 years.
The hotel sectors in major Asia-Pacific markets is improving due to a recovery in domestic travel and some inbound tourism. Weak currencies in Japan and South Korea are boosting demand from inbound travelers and keeping domestic tourists onshore. Domestic travelers, which makes up the most hotel guests in Japan, China, Australia, and South Korea, are expected to drive the recovery of the hotel sectors in this market. International travelers, particularly Chinese tourists, will gradually contribute to hotel demand. hotel operators has prioritized increasing average daily rates over occupancies in recent quarters. However, they are likely to face challenges in the future due to labor shortages and high operating costs. Therefore, hotel performance is expected to be driven by occupancies through tailored business plans going forward.
Similar to other regions, our investment recommendations for Asia Pacific favor debt-like positions and distressed equity positions in markets with tight lending conditions, such as Australia, South Korea, and Hong Kong. Logistics and multifamily continue to offer attractive relative value in the near term, but we are cautious of a decelerating rental growth outlook in select markets driven by rising supply pipelines. Spotting unique occupier demand dynamics in these favored sectors are critical in driving investment performance going forward. The hotel sector can be an attractive momentum play for investors with a higher risk tolerance. The office sector is the most unique in this region, with many markets at different stages of the real estate cycle, which offers some interesting opportunities. For example, there could be a short-term investment window for sole offices ahead of the supply influx in 2027, and sunny offices with green credentials if entry prices continue to be adjusted. We went into further details in these investment trends in the Asia Pacific chapter this year. We hope you enjoy reading LaSalle's 2024 ISA Outlook. Thanks for listening.